Good morning, and thanks for joining us again for the quarterly review of Tecnoglass. This morning, we announced record results once again. I'd like to take you to the first slide of our presentation. In the highlights, we basically recorded, a record top-line growth this year, up 50% against Q1 of 22, with both segments contributing nicely. Commercial growing almost 60% and residential growing 40%. We recorded a record gross profit margin of 53.1%, up 830 basis points from last year. We'll go into the details as to how that came to be. Going down the line, operating margin again at a record level of 36.4%. That was up over 1,100 basis points year over year, basically driven a lot by COGS, but also SG&A on much higher sales, as we just mentioned. So we got nice operating leverage on the quarter. EBITDA margin up 42.4%. Again, that was a record margin for us, driven by the same factors that we're going to go into here shortly. And going all the way down to the bottom line from an EPS perspective, we recorded at $1.01 EPS and an adjusted EPS of $1.08 per share. Again, record levels of EPS in the Q1 of this year. From a cash flow perspective, we also recorded the highest cash flow from operation and free cash flow at $43.1 million and $27.5 million respectively, on the back of very high profitability for the quarter. Moving into the next slide, the backlog continues to move up sequentially. And if we compare year over year growth, it came to be about 20% higher versus the same period of 2022. That continues to be driven by the growth on the commercial construction, mainly in the areas where we are the strongest, which are the Southeast and Texas. And as we have discussed before, the backlog doesn't even consider or doesn't include single-family residential work, because that's very spot in nature. So we're talking about only commercial construction, which is going to give us a lot of visibility over the next couple of years. And basically, 2024 is almost played out with the backlog that we reported in hand at $776 million. Moving into single-family residential and honing in as to how this is shaping up, the 40% growth was driven by demographics. Obviously, there's a lot of people moving down to the strongest markets where we're present, in the Southeast and Texas. There's a lot of population growth that is taking place. Remember that 2/3 of what we do is repair and remodeling. So it's an area that is not as sensitive to interest rates and to mortgage rates, and is driven by other trends. And if you think about it, those who are not moving into new homes are basically staying in their current ones and remodeling their current homes. And that's some of what we're seeing, as well as taking a ton of market share. Back into highlighting our structural advantages, we've discussed this in the past as to what is driving this continuous market share taken. We basically feel that we have a better value. We can price competitively. We can definitely be more quicker on lead times. And given our vertically integrated process, we basically control the process in a much better and leaner way. And that continues to give us a pretty significant advantage when we go into new markets, where we introduce a new product, or where we develop new commercial relationships. Honing in into revenues, 96-97% of our revenues continue to be U.S. driven. As we mentioned before, roughly 60% of our revenues are coming or came from the growth in the commercial segment, and 40% growth on the resi segment. If we are to look as to how that's weighted out, I would say it's a 60 to 55% commercial revenues, and then the remaining is single-family residential. So it's a nice balance and typically counter-cyclical. So it kind of weighs out over time. Adjusted EBITDA, we mentioned 42.3% EBITDA margin, the highest that we've ever had in the history of the company, driven by much higher gross margins. Also, operating leverage is playing a key part here. In the operating leverage, as we mentioned, both on the COGS, gross margin, and operating margin, SG&A as a percentage of sale came down because of that operating leverage that we're driving on the business, going from 19.6% of sales down to 16.8% of sales. So both lines or both segments of the P&L are contributing nicely to a much higher adjusted EBITDA as a percentage of sale. Moving on to highlighting margins and cash flow, as we have discussed in recent years, since 2019 to what we just reported in 2023, we have gone from 31% gross margins to 53% gross margins. And that's driven by many things. Operating leverage, as I continue to mention, we have invested significantly on automation. That's helped nicely. And the penetration into the single-family residential space, where we don't have any installation work, is very accretive to margins as well. So it's been a mix of factors that has allowed us to be where we are, north of 50% gross margin as a percentage of sales. Moving on to capital allocation, as a result of everything that we have mentioned, we're driving significantly higher returns for shareholders from a return on equity perspective and a return on investment capital perspective. We're basically 32% versus about 12% for the industry. On a ROIC percentage-wise, we're 18 to about 7% for the industry. So we continue, from a capital allocation perspective, we continue to focus on reinvesting in the business. We have invested roughly $120 million of CapEx over the last 2 years. Again, invested $15 million in Q1 of 23. And that's where we get the most returns, as you can see by these metrics. When we can reinvest in organic growth and basically become more efficient and drive operational leverage on the business, that's where we increase our returns and our value to shareholders. So finally, given the dynamics that we're seeing, and we continue to see a strong pipeline beyond the backlog that we have already booked, we continue to see a strong pipeline of business that gives us confidence that the tendency on the backlog will continue going in the same trend, and having a little more visibility as to what we have sold and will invoice through Q2 and almost into Q3 on the residential side, we're increasing guidance. We are now expecting revenues to be in the range of 810 to 850 million, up from 800 to 840 million previously. And on the back of that, and higher margins that we're expecting, we're increasing our adjusted EBITDA from 300 to 320 million previously to 315 to 335 as the new guidance point. So we look forward to continue the good news and hope to see you in the next Q when we report again. Thank you.